Good morning, ladies and gentlemen. Welcome to the Swiss Re Corporate Solutions webinar titled Together Tackling the Next Natural Disaster and Extreme Weather Event. My name is Steve Higginson. I will be hosting proceedings over the course of the next hour. The objective will be to have our four presenters present. If you have any questions, please type same up, and we will look to ensure that there is plenty of time at the end of the session to try and get back to you with answers thereupon. Just to set the scene, if I may, Swiss Re Group's mission is not to be an insurance or a reinsurance company. It is actually to make the world more resilient. The Swiss Re Foundation, which we set up, has a focus looking forward on a number of key areas in managing the climate and managing sustainability and resilience. And that is upon natural hazards, climate risk management, and innovation to build resilience. And realizing these sustainable development goals, we basically approach our obligations to share expertise and encourage out-of-the-box thinking and solve problems. And to achieve that outcome, we team up with the right experts. I do sincerely hope during the course of the next hour or so, you will concur that the speakers and panelists we have for you today apply exactly in that context of the right experts. Now, in the sequence of events we will have is that Clarence Wong, our Chief Economist for Asia, for the Swiss Re Institute, will lead off proceedings. He'll be followed by Jane Sexton, who's a Director of Hazard and Risk Infrastructure and Application Section in Geoscience Australia. Alex Pui, our natural catastrophe expert for the Asia Pacific region, will then come in third. And finally, Andre Martin, our Head of Innovative Risk Solutions for Asia Pacific, will close proceedings thereupon. Now, Clarence, who will be taking over very shortly, he is, as I've mentioned, Chief Economist in Asia for us. He has a master's degree in economics from the University of Hong Kong, and he's been with the organization for many, many years. And effectively, we'll be providing you with a framework within which the following three presenters will obviously present their cases. So if I may move straight across to Clarence for your presentation, please.
Thank you, Steve, for the introduction. Good morning, and thanks for joining the webinar today. I would like to spend the next minutes to briefly summarize disaster losses in 2018, as well as some of our key observations. In the slide, you can see that, again, last year we see a lot of disaster events. In fact, there were a total of 304 Natcat and man-made disasters in 2018, resulting in over 30,500 victims. Economic losses were $165 billion US, while insured losses reached $85 billion US. I think there are a few key highlights. First, last year's insured loss is the fourth highest one-year aggregate industry payout ever. It is also higher than the 10-year annual average of US $71 billion. Out of the 85 billion insured losses last year, around 88% were due to natural catastrophes. And of this, more than 60% were due to so-called secondary peril events. Importantly, even though last year's losses were lower than that of 2017, the combined insurance losses for 2017 and 2018 from natural catastrophe were $219 billion US, and that is the highest ever for a two-year period. I think this is indicative of a growing trend in economic and insured losses from natural catastrophes. Another way to look at this trend is to note that economic losses have increased by more than 7 times since 1917. The next slide shows not only the rising trend of both economic and insured losses, represented respectively by the solid and dotted line, but also a widening gap. Protection gap is divided here as the difference between economic and insured losses. And this has continued to widen despite increasing insurance penetration globally, but also in Asia Pacific. Actually, based on our Sigma database, over the past 10 years, 68% of economic losses caused by natural catastrophes were uninsured. There are, of course, year-on-year variations in the size of the protection gap. While in 2018, the gap was relatively benign at around 18 billion US dollars. The gap a year before in 2017 was more than double at almost 200 billion US dollars. On this slide, we would like to show the natural catastrophe protection gap by different regions. You can see that there is a large gap in almost all regions, from North America to Europe to Asia. But Asia Pacific has always the biggest protection gap among all regions. Australia, included in Oceania here, is doing better. I think large protection gap is a concern to us because this directly impacts on the resilience of societies. We would also like to emphasize that actually the insurance and the reinsurance industry is well capitalized to absorb this natural catastrophe risk and help to close the protection gap. We estimated that globally, the insurance and the reinsurance industry has capital of more than 2 trillion US dollars at the end of 2018, which should be more than sufficient to help to close the gap. We believe the key challenge is to better understand the reasons behind underinsurance and also to look for suitable solutions. Some of the main reasons or explanations for underinsurance could include, for example, lack of consumer awareness, poor understanding of cat insurance covers, and the need to understand localized risks, including secondary peril risks. My last two slides will show to you some key loss events in Asia last year. This slide shows in 2018, Japan was hit by major typhoons, including Jabi and Tami, but also floods and earthquakes, resulting in a combined insured losses of over US $17 billion in 2018. I think the key point here is to show the potential of large losses, not arising from only a single large event, but from a series of loss events. Another important lessons learned from Japan is that actually the SME, small and medium enterprise sector, they suffer large uninsured losses in Japan. SMEs in Japan make up almost 99% of the country's industrial and commercial bases in terms of employment, but many of them are uninsured. In fact, the Japanese government has taken look of this situation, and in November last year, the Small and Medium Enterprise Agency of the Japanese government set up the SME Resilience Study Group with the aim to generate higher insurance penetration for SMEs in Japan. I think this is at least a step in the right direction to improve resilience, and it highlights that in all of the markets, not just in Japan, but also in other Asian Pacific countries, not only the large corporations, but also the SMEs are hugely uninsured. Apart from the major losses from Japan, last year we also see a lot of other losses in different countries. For example, Typhoon Mangkhut in the Philippines resulted in total losses of 4.5 billion US dollars, of which 1.3 billion was actually uninsured. And also there were Typhoon Maria and Romia in China, which together resulted in economic losses of over 3.5 billion US dollars. Another notable event is the Kerala flood in India in August last year, which is also a significant loss event. In fact, it is said to be the worst flood in India in over 100 years, and that resulted in both in economic losses of 3.5 billion US dollars. Insured losses, again, is relatively small, at less than $400 million US. I think this shows that the penetration rate and also the insurance protection gap in emerging Asian countries is relatively large. As this example shows, the protection from insurance represents only less than 10% of total economic losses. In sum, we are still seeing a rising trend in both economic and insured losses from natural catastrophe, globally as well as in Asia Pacific. At the same time, the protection gap is widening, notwithstanding the fact that insurance penetration is increasing. And this is going to harm societal resilience. I think we need to think about how we can deal with this kind of situation going forward. And I hope the rest of the speakers will help us to understand better the dynamic between underinsurance and also the protection gap. With this, I will hand back to Steve and to take us to the next presentation.
Thank you very much indeed, Clarence. As I mentioned at the beginning, if you do have any questions on Clarence's presentation, please do type them through to us. We have received some already, and we will respond at the end of the 4 presentations. I'm now delighted to introduce Jane Sexton as the next speaker. Jane joined Geoscience Australia in 2005 to work collaboratively with the Australian government agencies to manage tsunami risk. Since then, she's contributed to the development of a range of modelling tools that can be used for disaster risk reduction and actively leads the application of these tools and techniques in partnership with government. Jane has a PhD in applied mathematics with a postdoctoral positions in combustion research for industrial problems. I'm sure we'll find Jane's contribution to this discussion most interesting. Jane, I pass over to you.
Thank you, Stephen. So what I will be presenting today really is an overview of the government context to enhance disaster resilience in Australia and the region, the policies and the capabilities that exist and are in development, the role of Geoscience Australia, the connection with a range of sectors, including insurance. So just released on 5th of April of this year, the Australian Government released this final version of the National Disaster Risk Reduction Framework. This framework was developed through extensive national consultation, led by the National Resilience Task Force, and included public and private sector and NGOs. The Australian Business Roundtable, for example, was a key part of this consultation process. This framework recognises 3 government and international strategies for disaster risk reduction and climate adaptation, including the Sendai Framework for Action, with the themes from these filtering through quite strongly, particularly the first priority for action remaining that of understanding disaster risk. So what are the key messages that filter through from this particular framework? And I've got 4 listed here. The first is shared responsibility. There was certainly some pushback with this terminology in the original strategy that the government posed in 2011, as responsibility and accountability for decisions is often beyond the ones that experience the impact of disasters. As with the publications most recently published by Swiss Re Institute, we all recognise that we are a society. We all have a role to play, and that our actions contribute to the overall system. So the National Resilience Task Force has sought to move this issue beyond what has traditionally been seen as an emergency management problem and attempting to mainstream disaster risk into all government policies. The next message there is about increasing availability of data and information for decision making. This has been a persistent message delivered to the task force that there simply isn't enough data and information to make decisions, and there will be a concerted effort to understand precisely what that kind of data and information is going to be. So clear steps that have been identified in the framework is about identifying those gaps, addressing technical barriers to sharing information across sectors, but also developing data and information that can actually be used and actionable for risk reduction. And as Clarence mentioned earlier, one of the key messages filtering through is around consumers not being aware of the risks so that they are able to make decisions. This is certainly not lost on the insurance sector from my understanding in the Australian context, especially for flood. Geoscience Australia has had direct experience of many of these issues as a result of implementing the National Flood Risk Information Project back in 2011. What we really found in that particular project was the real issue was around procurement and licensing of information, so that people can actually share the information that has been procured for the intent that it was procured for. The last message there is about risk-informed infrastructure development. So there's a range of policy platforms at the moment the Australian government is pushing. For example, developing Northern Australia. So there's an opportunity right now to build for a resilient future. That is, to not to build risk in now. But of course, existing developments rely fundamentally on critical infrastructure, the power, the water, the gas, communication and roads. It is these elements that have an extraordinary impact on us as individuals, families and communities, even when a disaster may not impact us absolutely directly. It is crucial, therefore, that this infrastructure is resilient for the developments that don't yet exist. And again, as referenced in the recent report by Swiss Re, there's an opportunity for public-private partnership in long-term resilience building infrastructure projects. And again, coming back to the theme of the Institute, what innovative activities can boost resilience across these various messages? Whether that's about information delivery, investment options, or indeed partnership models. So with all that in mind, you might be asking, who is GA, or Geoscience Australia, referred to as GA here? We're a unique capability in the Australian government where we can integrate geospatial and geoscience capabilities. We span a range of tactical and strategic objectives. We proactively partner and collaborate across government, industry and academia. We are active in the Bushfire and Natural Hazard CRC program, particularly in mitigation for the built environment and impact forecasting. Some of you may be aware that insurance agencies have been engaged in this program, as CRCs are all about bridging the gap between research and end users so as to translate research that can actually be used. Our capability encompasses the key elements of risk, of hazard, exposure and vulnerability, and we deliver that capability through a range of interrelated activities. This capability contributes to the themes of the framework around shared responsibility, about improving accessibility of data and information, as all of our data, information and tools are made openly available and discoverable. And we work alongside government and industry to deliver outcomes to build Australia's resilience. We apply this capability for strategic use, that is in planning and preparedness, but also at a more tactical level in response and recovery. We think there's an opportunity for further collaboration with the insurance sector. Understanding the level of impact to the Australian built environment is absolutely fundamental in building vulnerability models so that we can forecast what the future impact may be to the Australian environment. And this data at an open level is quite scarce. Our flagship products are the probabilistic hazard assessments. These national scale products are being used by government, industry and academia for a range of different purposes, including inputs to updates to the loading standards in the building code. And in the case of the National Seismic Hazard Assessment, the insurance sector. The recent release of this particular assessment was a significant update to its predecessors and one that the insurance sector has eagerly awaited. And as a result, we were invited to present on it last year at the Natcat Risk Modelling Conference in Sydney, and we'll be presenting at the 2019 conference as well in September, this time for the Tropical Cyclone Hazard Assessment. Much of GA's capability to date has been directed to emergency management questions, and there's been difficulty interpreting and applying these kind of probabilistic hazard assessments in their situations. Their questions are more like, we are conducting an exercise to test our processes. Do you have an earthquake scenario for location X? Can you help? There is certainly a growing maturity on assessing risk. However, the power of scenarios cannot be overlooked. They allow us to leverage history to show that the science is credible and then show what the future could hold. It offers an easier way to engage with communities and tell a story. And at the decision makers level, it allows them to ask what if. It allows us an opportunity to educate the community and therefore raise consumer awareness that not every event is the same and that we shouldn't expect the same as last time, especially when you haven't ever had a last time in your location. So in summary, my intent today was to give a flavour of what the government is doing when it comes to disaster resilience. Government certainly is partnering with a range of stakeholders, so not just government, with the aim of supporting the country to become more resilient. I also trust that you now know more about Geoscience Australia than you did before and see that we are developing sophisticated products that all of you can access to support Australia's resilience. Thank you.
Thank you very much indeed, Jane. I think that leads us perfectly indeed into the next presentation by my good friend Alex Pui. Now, Alex is a native Sydney-sider, although currently resident in Singapore. And apart from being a brilliant pianist and a bloody good golfer, he actually knows something about natural catastrophe modelling and the research therein. In particular, he has a deep interest in the impact of climate risk on society and is very involved in our alternative risk transfer modelling and assessment, which obviously leads us into Andre Martin as the final speaker. So Alex, without further ado, I'll pass it over to you to bring your particular flavour into the conversation.
Thanks, Steve. You're too kind, right? So can everyone hear me, Steve? All right, I'll begin. So my section, I think, flows nicely from the excellent presentation earlier from Jane. And it deals with how do we actually address climate change in an insurance context, right? So I think the main idea today is to give you just a really high-level framework on how to assess climate risk and why we need to do that right now. Because any talk on tackling natural disasters will not be complete without actually incorporating the climate element, all right? And just to set it off, central banks and financial regulators are actually now saying to firms, adapt or you will not exist in the new world. So it's gone beyond just an insurance problem, a natural disaster problem, but it's actually a financial stability problem, just underscoring how important this is. So actually, a framework to assess climate risk can be segregated into 3 buckets in general. So this was actually first introduced by the governor of Bank of England, Mark Carney, some years ago. So he dissects it into physical risk, transition risk, and liability risk. So for the physical risk, and that's what I'll cover the most today, it's really impacts on insurance liabilities and the value of financial assets due to weather and climate-related events. So think about your storms, think about the impact of maybe sea level rise and storm surge, increased frequency and severity of bushfire events, and all that disruption that comes from increasingly complex supply chains and growing economic densities in exposed areas. So that's really the physical risk element. However, climate change also exerts risks through transition risks. So that's more to do with, like if you're a firm that's really heavily invested in fossil fuels, for example, and there's suddenly this huge adjustment or very rapid adjustment that's needed towards low carbon economy. And that might be precipitated because we're tracking too far along in our emission scenarios, and climate change is hurtling towards dangerous levels. For example, the RCP, or the representative concentration pathway of 8.5 watts per meter square. So that really is the most extreme scenario that's been put out there by the IPCC recently. So if we're doing that, then there might be more drastic actions that need to be taken. And this would have follow-on impacts on firms that have, generate majority of their revenue or income from the carbon-intensive industry, like fossil fuels, or firms that actually invest in these, industries. And finally, not forgetting liability risk, because if the actors today are actually already aware of the impacts of climate change and do not do enough to guard against it, there might be liability action later on. So just to give an example, I think it's been in the papers recently that ATSIC and also APRA in Australia have been sort of warning companies. I mean, it's all voluntary at the moment in terms of the Task Force for Climate Related Financial Disclosures, the TCFDs, but in the future there could be legal ramifications. So coming back to physical risk, this is just a high level, right? Just to give you guys an idea of how we can incorporate the various elements here to be able to come up with an integrated approach to disaster risk management that adds economic value. So insurance, as you see, is just one part of it. It's actually a whole continuum. Starting on the left with climate projections. So like I said before, these are the climate projections in terms of temperature increase released by IPCC. So that's released at the global level. Obviously, it has to be adapted to your area or peril of interest, right? So then it can be used to inform, for example, cyclone frequency or intensity rates, intensification rates. So that flows into the next sort of subsection here, which is the catastrophe modeling section that I think Jane briefly touched upon in her previous slides. So Geoscience Australia is also very active in this space, and we collaborate with them. The insurance industry collaborates with the likes of GA and also other vendor models, right? So we use these climate projections to inform the hazard models, to tweak and trend, to see whether there's any trend element, and then we perform the catastrophe modeling exercise, which in a nutshell is then superimposing that hazard over our exposures. So where are our risks located and so forth, right? And then it translates into an economic loss. And at the end of this, we have a risk profile, basically, of the exposures. And then we can decide to do either risk mitigation or risk transfer or both. I mean, building seawalls is one example against storm surge to be able to mitigate against sea level rise and increasing ferocity of the storms. And any residual risk could then be transferred to a risk taker, such as an insurer or even the alternative capital markets. So I think my point is that insurance just plays a role, but it's not the answer to everything. But we need to look at it in a holistic manner. And at this point, speaking of risk transfer solutions, I'll now hand it over to my colleague Andre Martin, who will take you through parametric solutions.
Thank you very much indeed, Alex. As indeed Alex has just said, ladies and gentlemen, we've gone through the sort of large economic picture. We've driven that through government participation in terms of looking to make the society more resilient. Alex has now brought it somewhat a little more specifically into the context of mitigation and transfer of the risk we're talking about. So clearly the last presenter was going to hopefully talk to you about some solutions that we may offer in that regard. Andre Martin is certainly the only person from Luxembourg that I know who is also an Olympic level swimmer. So he's an unusual gentleman who holds a master's degree in mechanical engineering as well as an MBA from UNISA in Adelaide. Andre is head of our Innovative Risk Solutions business for the Asia Pacific region based in Singapore now. And Andre will now give you, hopefully, a few fillip to the slightly sort of challenging messaging that's coming through from Alex to advise that there are certain solutions that we can offer which might be able to assist. Over to you, Andre.
Yes, thank you, Steve, and good morning, ladies and gentlemen on the line. Now, parametric insurance. I think most of us have heard the term in the recent past, and I think over the last couple of years, parametric or index-based solutions certainly have gained an increased popularity also in the insurance sector. Now, what I want to do in the next 10 minutes is really shed some more light around the fundamental basic and the principles of parametric insurance, but also showcase how parametric insurance can actually complement and fill the gaps of traditional insurance programs and ultimately help to close these insurance or these protection gaps mentioned in the earlier slides. Now, what exactly is parametric insurance, and how can it achieve things that apparently traditional insurance cannot? Now, as insurance practitioner, I think all of us know are very well aware that traditional insurance is purely indemnity-based. So this means that it compensates the insured for the cost of repair or replacement of a physical asset that has been damaged. Put very simple, plus any consequential financial loss thereof. Now, index-based solutions are fundamentally different because they cover only the probability of a pre-agreed event happening. So they essentially rely only on the measurement of an index or an event. Like, for example, the magnitude of an earthquake in a certain region, or the storm category of a tropical cyclone on an island. So, and with that, in parametric insurance, they are completely detached and independent from the underlying asset. The payout is usually formulaic. That means it's a very simple function of the severity or of this measurement. Now, once the threshold, the measurement exceeds a certain threshold, the policy is triggered, and the payout follows almost immediately. Now, in order to choose an adequate index or parameter, there are certain criteria that should be observed. So first of all, we have to make sure that it's objective and independent. So nobody should be able to influence this measurement or the index. Then it has to be reliable and available, as well before the event, but also more importantly, after event, so that we can assess whether or not the policy has been triggered. But the most important criteria for these parameters is really that there has to be a strong correlation between the index and the actual financial impact to the insured. So because the index is always only a proxy for the actual financial loss sustained, there will always be some element of residual basis risk. Now, basis risk is defined as being the difference between what the insurance pays out and what is the actual loss sustained by the insured. And it is the art of structuring parametric solutions, but also to choose the right triggers to really try and minimize or limit this basis risk as far as possible. Now, based on these fundamental principles, what are the benefits and what are the applications for these index-based solutions? First of all, we see them very useful to cover what we call the uninsurable perils or uninsurable asset classes. And one prominent example here is really overhead transmission distribution lines, which are standard exclusion under the traditional PDBI policies. And with that, they really lend themselves also very well to cover pure economic, pure financial losses that are not caused by physical damage. And this is where we're entering the whole area of the non-damage BI. And one example here, which is quite prominent, is really protecting supply chain disruptions. A third application is certainly where we're talking about scarce capacity, like, for example, earthquake in Japan, because they have proven to be a very efficient instrument, not only to access insurance capacity, but also to access alternative capital markets via ILS, via cat bonds. Then another feature is really because there is a formulaic payout and there is no traditional or no claims investigation process involved in the traditional sense, they allow for very fast, very transparent payout of the insurance proceeds. And this is really where we see them very often deployed in situations where quick access to liquidity is of essence. Here I'm thinking mostly of local government, local councils who really need this quick access to cash after a major event for emergency relief actions. Now, most important message that I want to give here as well is that parametric insurance is not designed to replace traditional insurance. It is there to complement it, to sit side by side and try to fill some of the gaps. Now, on the right-hand side, you will see on the slides a very simple example of a parametric solution. In this case, it's a cat in a box or cat in a circle, which has proven to be still the most prominent, the most popular instrument to cover natural catastrophes. So in this case, the insured wanted to protect himself against typhoons in the Philippines. So he came to us and identified the areas where most of his assets were concentrated and represented here in these yellow circles. And if a typhoon of a certain strength passes through that circle, policy is triggered and a payout follows according to a very simple formula, which is a function of the strength or the category of the storm. Now this slide here summarizes the key features, the key elements of a parametric insurance. And I just want to point out probably the most striking element, which is that the vulnerability or the risk quality of the underlying asset class or asset does not even enter the equation. We are only interested in the probability of the hazard or of the event occurring. Now, as I said before, there is no loss investigation in the traditional sense. A formula payout will follow almost immediately. And this allows the insurer to ensure a very quick, a very transparent loss settlement. So in these situations, we usually guarantee payout of the insurance proceeds within 30 days of the event happening. Now, looking at a couple of real-life examples, I mean, the questions are often, what are possible triggers and what are the most popular or prominent triggers or indices that we see currently? And I've tried to group them here into four main categories. Now, it wouldn't come to any surprise that currently the most popular prominent triggers are still from the Natcat area. So here we're talking tropical cyclone, earthquake, flood, or drought. But we can not only cover this extreme weather event, but also just cover or protect against adverse weather or inclement weather. Like, for example, too many rainy days or too many windy days delaying construction projects. On the flip side, we can also say, well, we can also protect against not enough windy days or not enough sunny days. The example here would be renewable energy projects like wind farms and solar farms. Then over the last couple of years, we also see an increased interest in so-called non-weather related indices. And here examples would be protecting against loss of attraction, which is measured by an hotel occupancy rate. In Australia, we're currently piloting a new product, parametric product against bushfire. We have developed an application for volcanic eruption. Another application which is proving to be quite popular in Europe is protection against regulatory shutdown of operations or loss of license. Now coming to the last category, insurance in general, they shy away from taking pure market risk. But there's certainly appetite for application for so-called multi-trigger or double trigger applications, which basically try to combine, in this case, a weather index and a pure market index. One example here would be protecting a utility against a long and hot summer where demand surges and a concurrent spike in wholesale electricity prices. And as you can see, overall, quite a range, broad potential for possible indices. And as long as this measurement is one, fortuitous, and two, can be modeled, it certainly qualifies for a possible application. Now to close, I want to showcase a real-life example of a concrete deal that we have executed here in Australia. And in this case, the insured was an island resort which got severely impacted by Tropical Cyclone Debbie in 2017. And the key driver behind the parametric solution was actually the loss of attraction and the wide area damage on the island. So the insured in this case was very well protected by a traditional PDBI program, which was triggered and also paid out for the repairs and also the BI loss. But once the hotel was up and running again, most of the island was still a bit of a mess. The golf course was not ready, and a lot of the tourists, the majority of tourists, had Derby still fresh in their mind, and they cancelled all the bookings. So overall, the island suffered quite a severe economic impact just due to this loss of attraction as a tourist destination. The solution here was a cat in a box, very similar to the example of the Philippines shown earlier, where we basically did an economic impact analysis and defined these what we call indemnification zones, but in essence it was a box. And once the typhoon passes through this box, policy is triggered and a payout follows as a pure function of the category of the storm. So quite a simple but a very powerful solution that allowed this insured to protect against the pure economic loss which was not covered by the traditional PDI policy. Now, I hope these few slides have given you a bit of an overview what index-based or parametric solution is, but also how it can be used to fill the gaps of traditional insurance, and as said before, closing the gap or this insurance gap that we see widening increasingly. And with that, I would pass on to Steve for the Q&A.
Thank you very much indeed, Andre. Thank you to all of our presenters. I hope that everyone who's joined the webinar has followed the theme that we've tried to sort of have all the way through. Delighted to be able to say that we've got a fair number of questions coming through. And what we would look to do now is we will put the questions up on the screen, so everyone who's on the webinar can see those questions. So we hope the technology will work. And here we go. First one, Clarence. You can obviously read it. It says you mentioned that in 2017 and 18 combined with the worst ever 2-year period for Natcat losses, and the trend is rising. However, stats show that Natcat losses in 13, 14, 15 were below average, and 2011 was the worst ever. So at best, there's been a lot of variability in losses incurred. Please can you explain what constitutes an increasing trend? Clarence.
Yes, thank you, Steve, and also thanks for the question. I think the pattern of the Natcat losses is invariably quite different one year from other. 2017 has been quite high, and 2011 has been the highest in terms of economic losses, but 2017 has been highest in terms of insured losses. When we look at the trend of Natcat losses over time, we tend to look beyond the 10-year period. We actually look back as far as our Sigma database is available from the 1917. And this clearly shows an increasing trend in terms of the number of events, the total economic losses from those events, and also the insured losses from those events. I think the trend of increasing losses are quite clear if you look at this from a multi-decade perspective. The key question is what drives these increases? Are these driven by increasing concentration of wealth in those disaster-prone region, or is it simply because insurance has failed to catch up with the economic growth? I think these are some of the key questions that we would like to address in our research concerning natural catastrophes.
Thank you very much, Clarence. I hope that provides an answer to the question. If not, please continue with the questioning. We'll move on if we may. In terms of risk mitigation modelling, do we have good data on what actions are effective or not, e.g. seawalls as mentioned? In my understanding, these are not real mitigations in any long-term sense. Alex, your thoughts?
Yeah, no, that's a good question. I think in the sense of, I mean, there are many risk mitigation measures that can be taken, and I think those that are taken proactively are normally a little more effective. I think in Australia, there's been a push to not build in flood zones or bushfire zones. So that's a form of risk mitigation in my mind. Seawalls, they'll be more effective, say in Hong Kong or other places. And I think, even flood diversion canals. So if you look across APAC to Japan in Tokyo, they've actually got one of the most, in my mind, an engineering marvel. I've been lucky enough to visit the site. And it's actually an underground flood discharge tunnel that in north of Tokyo in Saitama. It actually feeds flash flood or discharge, rainwater discharge down, stormwater underneath Tokyo, and it pumps it out into the Greater Tokyo Bay at a rate of, I think, an Olympic-sized swimming pool 6 stories high per second or something like that. So these are all risk mitigation measures. And I think that, risk mitigation measures, I think it really is a function of how severe the threat is, right? And, there's no one-size-fits-all answer, and it will not be able to mitigate against every loss, but it can mitigate against what you see as a rising threat. And I think, in my mind, the best risk mitigation is prevention, right? So the risk mitigation measure that helps the most is really, adaptation plus, reducing carbon output, because that is the best risk mitigation measure.
Thanks, Alex. And Jane, if I might come to you from a Geoscience Australia government perspective, your thoughts?
Yeah, well, I was just reflecting on some current work that we are doing actually in a small town in Western Australia called York, where we're conducting research on how to mitigate historic buildings there, which are deemed to be clearly of value if there was to be an earthquake in that particular location, because there was an earthquake nearby back in 1968 that actually devastated a small town. So there is research occurring through the Bushfire and Natural Hazards CRC that actually looks at structural mitigation to the existing built environment to mitigate risk. And a lot of that work is bringing in the cost-benefit aspect as well. So I think that's possibly something, because that's where most of the legacy buildings in Australia is probably what's often driving a lot of the risk, from my understanding.
Thank you, Jane. And in light of your thoughts there and Alex's prior to your good self on the bushfire risk, the next question that will pop up onto the screen, we hope, is: can you provide examples of how parametric insurance applications can be used for Australian bushfire risks? Andre.
Yes, thanks for the question. As I said before, we're piloting a parametric bushfire product in Australia, but also in the US. And basically, it is based on satellite imagery. So you measure basically the vegetation before and after the event, and it's purely a surface that has been burned. So, but as I said, at the moment, it is in pilot phase, so we hope to be able to roll that out.
Thank you, Andre. And we thought, in light of your comments about indices and what can be defined as an index, how about this one? I had a client interested in cover for dust storm. Is this something that could be considered?
The closest thing I think that we have done was the haze product in Singapore, which is a pollution index which is also impacted by the wind coming from Indonesia. But dust storm as such, because it's quite localized, it's something that is probably very, very difficult to model. At the moment, we don't have any models who could do that, but an interesting one.
Thanks, Andre. And I might just say that it's probably not too dissimilar, Andre, to volcanic eruption and volcanic cloud, ash cloud.
It is
right.
not. It's more the question is really what is the I think it is.
Yeah. Okay. In the recent years, the next question. In the recent years, there is an increased frequency of major events in Queensland or the east. However, it would appear that CAT models are negatively weighted to Western Australian exposure. Is there a view that models are not reflecting reality? There's one. Who's going to respond to that punchy question?
I could take a stab at it.
Good man.
As a CAT modeler, I feel responsible. Okay, so I think that's a keen observation, but you need to understand first what's driving that apparent, mismatch, if it were. So I think the CAT models might be underestimating or underestimating the resilience of structures in the western part of Australia. but it's not necessarily underappraising the hazard risks. So that would be my view there. And I think all models, all models are wrong, but some are useful, right? So I think these models need to be sense checked, and they're meant to be some form of reflection of reality, but they need a lot of sense checking. So you need to understand why the models are maybe underestimating, for example. So, I'll give another example where models can come in on the other end. I think your question was saying models are saying there's more risk in Western Australia via Queensland, but recently, I've done talk in Hong Kong. I'm actually in Hong Kong right now, and I've looked at 3 storms that came through the northwestern Pacific Basin, one after the other. So it was Haima in 2016, Hato 2017, and Mangkhut in 2018. So they were all 1 in 25-year return period or greater storms, as per our sort of model estimates. But the likelihood of 3 of them co-occurring like that consecutively, if we assume the static climate, that's actually a 1 in 15,000 chance. So just to give you a sense of uncertainty sometimes. Models can miss both ways, so you need to use expert judgment.
Thanks, Alex. Now, Jane, we're going to pop back to your good self. Nice little question that's come in. Understand the establishment of the Australian Space Agency in 2018, the government made funding available to significantly improve Earth observation data from the 1970s up to now. Can you explain how this data will improve natural peril modelling, especially flood and bushfire exposures in Australia?
Okay, I'll make a comment against this rather than attempting necessarily to answer it directly. But one thing I'm not sure whether whether the insurance sector is aware of, but there is already a product available called the Water Observations from Space product that GA developed some years ago, and it is regularly updated. It shows historical surface water observations derived already from satellite imagery for all of Australia from 1987 to present. So that same technology would look then to go back that short time. The one thing I would say with regard to improving modelling into the future is that whilst models are built, and as Alex said earlier, is that some models well, lots of them are wrong, but these probabilistic models will rely on historical catalogues, and so having a good representation of what has gone before is obviously very good. However, this is only a short record, and so depending on the hazard that you're looking at, you really need to have a much longer record, and you still rely on the statistics within your modelling. So it'll be useful, absolutely, I'm sure, but and it will help validate potentially, but there will also be a question of resolution of the satellite data and how useful that will be for the actual modelling itself. But if I could suggest having a look at the existing product of the water observations from space, which does give an indication of, we're not professing that it is a flood data set, however it is using satellite imagery to look at historical surface water observations, which is typically from floods. So that's all I can really say about that. I don't really know much else about the Space Agency and where the funding is, but I can take that on notice and put you in contact with a relevant person here at GA who will also know a bit more.
Brilliant, Jane. Thank you very much indeed. Thank you. We will move on. We have a few more excellent questions and looking to try and fit as many as we can in with the time. So can you outline what categories of losses are included in the economic loss class? Clarence?
Yes. Economic losses are mostly the direct losses attributable to a major event, for example, damage to building, infrastructure, vehicle. The term also, or these losses also include those coming from business interruptions as a direct consequences of the property damages. So it does not include the indirect losses, and it also does not include losses on the life of people. So this is a very rough summary of the economic losses. Insured losses is also the same concept, also referring mostly to P&C losses, coming from losses of property, vehicles, infrastructure, and BI losses, but it does not include any life insurance losses. So I hope this could provide a brief update on the definition.
Thank you, Clarence. Thank you. I hope that has answered the question. We'll pop on to the next question. In the last cat-in-the-box scenario, does the policy allow for more than one loss? And following a loss or payout, does this change the appetite of the insurer to offer the product again or increase the price, Andre?
Yes, I mean, definitely it can offer more than one loss. So usually these are structured that you have a limit or payout for one loss and then an aggregate limit. So it can be 2 or 3 events. So that's during the policy period, not a problem. The appetite and the price, I mean, the probability doesn't change. And as I said before, we are only insuring or cover the probability of an event happening. So the only reason why the price changes is if there's obviously scarce capacity and it gets scarcer, then the capital cost will increase. So there is certainly an element of that, but it's not. It doesn't see the extreme variation that probably you would see in the traditional insurance post an event. The other thing is really usually these parametric products are multi-year to give the stability and the certainty over a longer period.
Thank you, Andre. I hope again that answers the question. Ladies and gentlemen, we are coming towards very much towards the end of the webinar. We have time, I think, for one more question, which will pop up shortly, which, Alex, is probably to your good self. Insurers often refer to flood exclusions on policies for risks above the 26th parallel in Australia. Have you done any modelling for this?
We have. I think the exclusion comes from because of the, as Jane mentioned earlier, like how blunt or how sharp are your tools to appraise risk, because we can only take risks that we can adequately price for, because otherwise we're just assuming risk that we don't understand, or it is, basically I think the resolutions aren't good enough to give us sufficient comfort to take that risk. So I think short answer is yes, we can do it, but very cautiously.
Right. Thanks, Alex. Ladies and gentlemen, we're pretty close to coming to the end. Thank you so much to everybody for your questions. We've received a tremendous number. What we will do as we're coming towards the end of the time on the call itself is we will get email responses to everyone for the questions that you've so kindly presented. So no one's questions will remain unanswered. I sincerely hope that you found this to be interesting, informative, and hopefully enjoyable. We do appreciate that it's an hour of your life. We don't want you having that standard expression, it's an hour of my life I wouldn't get again. We hope that you found it, as I said, interesting and enjoyable. It's the first of a series. We will be theming the concept of resilience and natural catastrophe and sustainability into our various webinars going forward. Obviously, we're also trying to offer, where possible, insurable solutions to some of the challenges that those particular ingredients in the world do present to us. So it remains, if I may, to thank Clarence and Jane, Alex and Andre for their contributions. Sincerely hope that you've enjoyed it. To one and all, thank you for joining us. I sincerely hope you'll join us for the next iteration, which will be coming out in a month or two from now. Thank you to everybody for joining. Goodbye.